There are three distinct tax advantages. You have tax-deferred growth of the cash value of tax-free policy loans, tax-free death benefit. My name is George Saradakis. I am an associate at Hirsch Financial Services. And today we're going to do a bit of a dive into different strategies that we could implement using cash value life insurance. Now, most people think that life insurance is just a tool for exclusively death benefit. And to a certain degree, they're right. But what often goes overlooked is that various types of life insurance could actually provide a living benefit and could serve as a financial tool while we're still alive before our beneficiaries get a death benefit check. So today we're going to break down exactly how these strategies work, who this is actually for, and if it actually makes sense. And we're also going to look at some cons as to what may happen if this strategy happens to go wrong. But first, I think it's important to take a step back and understand life insurance as a concept first. So what happens is life insurance is a tool that provides a death benefit to our beneficiaries upon our no longer being here. And that death benefit can be used as a means to provide income and supplement what we were making. It could be used as a means to pay off any outstanding debts or even continue leading the lives that our loved ones were used to living while we were here. And when we look at life insurance, there are two primary categories that we consider. The first is term life insurance, which is a pure protection type of policy, does not really provide any cash value. And it's kind of, we're paying for the policy for a specific period of time, after which the policy expires and we no longer have to pay premiums, which also means that we also don't have the availability of that death benefit if something were to happen. On the flip side, we have permanent life insurance policies. Permanent life insurance provides lifetime coverage as long as the policy and the premiums are being paid. And it also provides a cash value accumulation built within each of these policies. And so when we look at permanent life insurance contracts, there are three main types that we look at. Whole life policies provides a guaranteed cash value growth at a fixed rate, as well as fixed premiums that are to be paid over the course of the policy. The second type of permanent life insurance is what's called universal life contracts. Universal life takes the characteristics of whole life in that it provides a fixed guaranteed cash value growth, but it offers a flexibility in premiums whereby we're able to maybe pay a little less on a monthly basis, or maybe just not pay the policy for a month or two or however long we can. Doesn't really have that strict sandbox that whole life insurance has. Universal life would end up becoming the precursor to what is now called variable or indexed universal life, where we have the same flexibility of premiums as universal life. However, the cash value will grow because it's invested in the market. Therefore, it participates in market appreciation, but also has downside exposure to the market, just as if it were invested in a brokerage account. And so variable universal life has a more diversified portfolio, and indexed universal life invests the cash value in common indices such as the S&P 500, NASDAQ, the Russell, or any other major index that are available to us. And so when we consider the opportunity for living benefit, what we're usually referring to is the cash value that's built within permanent life insurance contracts. As I mentioned, cash value may grow in any particular way. Again, if it's a whole life contract, it's at a guaranteed fixed interest rate. If it's a UL policy, a regular UL policy that also has a guaranteed fixed income rate. If it's an IUL, it appreciates based on the index participation that the funds are invested in. And if it's a variable universal life, it's invested in a broad basket portfolio, which is exposed to the market and appreciates based on market highs or depreciates based on market lows. And so through cash value, we have the opportunity for policy loans. Now, Policy loans is essentially when we borrow against the cash value that has been built within a permanent life insurance contract. A policy loan is a tax-free access to the cash value. However, just as every other type of loan, life insurance loans carry with it a stated interest rate and also have to be repaid, or the policy death benefit will just be reduced by the amount of the outstanding loan upon payout. And a little bit more on policy loans in the coming sections. But before we get to that, we want to take a look at the tax advantages of maintaining a life insurance contract. And there are three distinct tax advantages. The first is that we have tax deferred growth of the cash value within the contracts. The second is that we have the opportunity for the aforementioned tax-free policy loans. And then the third is the primary purpose for purchasing life insurance, which is a tax-free death benefit to our beneficiaries. So at the end of the contract, especially in a permanent policy, if we were to pass away, our beneficiaries will receive that death benefit federal income tax free. When we discuss a living benefit, we're usually referring to the cash value, as I mentioned before. And so when we discuss this, there's usually a strategy that's involved with regards to implementing a living benefit. And that strategy is typically called and referred to as overfunding. So what happens is we fund the policy beyond the stated minimum premium. So if our premium on a permanent life insurance contract is $300, and from that $300, we have maybe $50 going towards the cost of insurance, which is a monthly or annual charge for our maintaining the insurance based on our age, health, etc. And then the remaining $250 goes towards growing and accumulating that cash value bucket. If we were to overfund the policy by an additional $200, then that additional $200 doesn't have to go to the cost of insurance. It actually goes directly towards that cash value. So over time, this overfunding of the cash value just perpetuates and accelerates the growth of the cash value over the policy lifetime. However, when we look to overfund a policy, there is a delicate tightrope that we want to look to walk, because we want to avoid turning the policy into what's called a modified endowment contract, or a MEC, which is essentially an IRS limit where we lose the tax advantage of maintaining life insurance. So a modified endowment contract will pay out a death benefit. However, we're not able to maintain that tax-free status of the death benefit to our beneficiaries. The death benefit then becomes taxable, and any withdrawals from the policy become taxable. So who tends to use this strategy? Well, there are three main cohorts that come to mind immediately. The first is high earners who are already maxing out their 401k and IRA or Roth IRA contributions. The second are business owners who are looking for tax advantage vehicles beyond the traditional retirement accounts that they already maintain, whether it's a 401k, an IRA, or some combination of the two. The third are people who find themselves in high tax brackets and look to reduce taxable income either in the near future or during retirement. And so overfunding the policy sets us up for what's called an alternate income strategy. And this is a concept when we look at retirement income. It's a strategy that is used to complement Social Security, maybe a pension, and any kind of withdrawals that we have from various investment accounts, which also provides a tax diversification of this income. Think about it. If we have a pension, which is looked at as taxable income as ordinary income tax, and Social Security, which is taxed as ordinary income tax, taking out a policy loan is similar to taking out money from a Roth IRA, because it's tax-free money, which doesn't affect Medicare in retirement. It doesn't affect our Social Security eligibility or Social Security income in retirement. It essentially helps to provide a cushion from a tax perspective. While this strategy sounds well and good, there are downsides that we want to consider. The first was that modified endowment contract, that MECing of a life insurance policy, where on the overfunding side, we want to make sure that we don't overstep that limit, because then we lose the tax advantage that we're looking and working so hard to build. This isn't the get rich quick strategy. This is something where the cash value grows slowly. It's invested. Just like all investments take time to grow, the cash value takes time to grow as well because those funds are also invested. We also have a drag from the cost of insurance. This tends to happen more in our later years because life insurance becomes a little more expensive to insure the insured while they're getting older. So, insuring a young, healthy 27-year-old is a lot cheaper than insuring an 85-year-old. So, that's another consideration as well. Life insurance policies also implement what are called surrender charges, and this is typically characteristic of the first 10 to 15 years, after which the cash value tends to be whole. So this tends to happen on a sliding, decreasing scale, whereby the chunk and the bulk of the surrender charges happens within the first 5 years, and then it significantly decreases. But we still are within the surrender charge period for about 10 or 15 years. There are three distinct tax advantages. The first is that we have tax deferred growth of the cash value within the contracts. The second is that we have the opportunity for the aforementioned tax-free policy loans. And then the third is the primary purpose for purchasing life insurance, which is a tax-free death benefit to our beneficiaries. The final risk is that we want to make sure that when we are taking out policy loans, we don't detriment the policy to the point where it ends up lapsing. Now, this is a pretty big deal because if we overdo it with the loans between withdrawal of loans and the interest that's accruing on top of the principal, we want to make sure that we maintain enough cash value to cover the cost of insurance. Because if the cash value within the policy falls deficient of the cost of insurance, the policy ends up lapsing and we lose the policy entirely. We lose the death benefit. But more critically than that is that the outstanding loan amount becomes taxable to us in the year that the policy lapses. So if I have a life insurance policy with a $50,000 loan and it just so happens to lapse this year, then I also have to report an additional $50,000 on top of what I've made from my job and other investments as income when I file my taxes in April. That's a huge deal. So when we work with clients or any individual who's looking to take out policy loans, we really want to make sure that we're not overstepping bounds here because we want to maintain that life insurance, not just for a tax perspective, but also because we want to maintain that death benefit for our beneficiaries in the future. Now, considering the strategy isn't for everybody, we want to make sure that when we work with clients or anybody in this way, we want to make sure that they're taking advantage of any 401ks or any investment opportunities they have first in a tax deferred way. We also want to make sure that they have a genuine insurance need. The primary purpose of life insurance, first and foremost, is to provide a death benefit to our beneficiaries on a federal income tax free basis. So we want to make sure that we approach life insurance in that light first, and then we can address maybe approaching the living benefit angle of maintaining that life insurance contract. And other things we want to consider as advisors is the income level that the client maintains, their time horizon for the funds, and any kind of financial discipline that they have, and their level of patience. Because again, this is a long-term investment strategy. Another strategy for cash value life insurance is providing generational wealth. Now, we're going to take a step aside from the living benefit angle and how life insurance is used from a death benefit perspective. The death benefit could provide a wealth transfer for the next generation. So that's because the life insurance death benefit provides tax-free wealth, tax-free benefit to our next of kin, whether it's our children, our spouse, or whomever. Affluent families tend to utilize permanent life insurance contracts within what's called an irrevocable life insurance trust, or an ILIT, I-L-I-T, which means that the policy, the life insurance contract, is owned by the trust, not the individual. So if I have a life insurance policy that's owned by an ILIT, I am not the owner of that contract. It's owned by the trust. And because of that, the death benefit doesn't get paid to my beneficiaries directly. It actually goes into the trust. Therefore, it reduces my overall estate and passes outside of the estate and is not subject to the estate tax. So, what that means, practically speaking, is that if my estate is X, and if I happen to go beyond the estate tax limit, my estate will be taxed at 40%. But if my life insurance passes outside of the estate through the trust, it doesn't get looked at from an estate tax perspective. So the life insurance is truly taxed at zero on a federal level and at an estate level. And that's a big deal. And so what happens here is that we're able to maintain the policy loan strategy from a living benefit perspective, and our next generation is able to realize the death benefit net of any outstanding loans. So if the policy is $1 million, but I have $200,000 of outstanding loans, my beneficiaries will receive $800,000 tax free, which they could then use to purchase a new life insurance contract and begin their own cycle of living needs from the policy, as well as establishing a tax-free death benefit for their heirs. And so, because of this, in this light, this strategy almost forces a multi-generational and an extremely long-term perspective that most financial strategies don't necessarily have the opportunity to offer. To recap this entire thing, we take a look at life insurance not just as a death benefit play, which that is the primary reason for life insurance, but also as an opportunity to provide a living benefit for us before the death benefit has an opportunity to pay out. And in the right situation and in the right hands, this is a very beneficial living financial tool that could provide tax diversification to us during retirement. Now, I want to be extremely clear when I say that this strategy is on an it depends basis. We want to make sure that we're taking advantage of other avenues first before we consider this strategy. We want to make sure that we're taking advantage of 401k. We want to make sure that we're taking advantage of any Roth opportunities that we have, as well as any after tax investment accounts for the future. And so if we already maintain a permanent life insurance policy, one thing that we want to do is take a look at what the cash value within those policies are, and if we're able to take advantage of the overfunding concept. But again, that's not the primary purpose of the life insurance. The primary purpose of the life insurance is to maintain that death benefit for our beneficiaries. And then we want to make sure that we're taking advantage of any retirement plans or any long-term tax deferred opportunities that are available to us. And then we can consider approaching a financial planner or a financial advisor, any kind of financial professional with regards to this overfunding life insurance cash value strategy and concept. And with all of that being said, if you have any questions or if you found this at all interesting, please drop a comment below. Subscribe. I'm trying my best to make sure that we are providing as much value and information and education as possible. So if you have any suggestions for future videos, drop them in the comments below. And I look forward to seeing you guys again soon. Thank you so much.